What's going on, y'all? Hope all is well. Another episode of Combos with your CFP Mario Payne in beautiful Jacksonville, Florida. I've gotten this question quite a few times. I guess it's past tax season. Tax season was a few months ago. But hey, Mr. CFP Mario Payne, why is it that some people pay zero in taxes? So watch the YouTube video. Going to react to that YouTube video, see how they say, what they say, how they do it, and we're going to just be a CFP and say, is that right or is it wrong? Steps you can do to avoid taxes, not evade, because tax evasion, that's going to get you locked up. Avoiding taxes, that helps from a deduction standpoint and a tax credit standpoint. So we'll talk about strategies and see what is going on. Before we go, like, subscribe, share our channel. Trying to get to 1,000 subs. Got a crawl before you walk. I got more clients and subs. Got over 1,100 clients worldwide and got about 400 subs. But we working on it though, just a few months in to get this knowledge. And also check us out on the App Store. Let Bob. Me and the team have our app on the App Store. Let Bob. Also check out our ETF. LETB as a boy. Pretty cool, right? First black-owned AI-powered ETF ever on the stock market. But let's see how people are avoiding, not evading, avoiding their taxes.
Most of us have known or at least heard how many of the richest people in the world don't really pay as much in taxes relative to the average American.
News out that Amazon is paying zero in federal income taxes.
Major development involving Donald Trump's taxes.
He's paid nothing in federal taxes.
I know people that are making a tremendous amount.
Now, it seems like a long time ago. That was 2015. But man, wasn't that election ridiculous? We had Hillary on one side, Trump on the other side. That was the election of all ages right now. That was just like, anyways, though. Time has passed, but man, 2015, 2016 election season, that was just, boy. It is what it is.
Of money and paying virtually no tax.
I pay no taxes. That's why Trump pays no taxes.
But the question that we are left with is, how do they do it? How can they legally avoid paying taxes when we know how aggressive the IRS can be? In order to understand how the rich avoid taxes, it is important to understand that not all income is created the same, and each one has a different set of rules that allow people to keep more of what they made. To illustrate this, let's use Robert Kiyosaki's cash flow quadrant.
First off, this is true. All income is not the same. It's the difference between income and money we receive from a capital gain standpoint. Income is what we work for. Punching the time clock working. If we make $100,000, we're in a basically 25% tax bracket, kind of round up, really 28%. So if we have $100,000, $28,000 before any deductions, any tax credits goes to the IRS. That's income. We're punching the time clock. Then you have your capital gains. Let's say I make $100,000 of my investments, right? Well, from a capital gain standpoint, we have long-term capital gains, short-term capital gains. Short-term, less than a year. When you buy it, then you sell it. You got to pay what your income rate is. Again, let's say 28% in that standpoint. But if it's more than 1 year, then you only have to pay 15%. So if you remember the elections with President Obama and candidate Romney, the thing was, Mitt Romney is paying less taxes than his secretary. And that was true. Even though it could be $100,000, if the secretary's punching the time clock, making $100,000, she's paying $28,000 before any deductions to the IRS. Mitt Romney made $100,000 on his investments, and he's getting paid from his investments, not from a salary. He's only paying 15%. So yes, if we use our capital gains and our investment money that we make from the sale of an investment, that is going to be less money from a tax standpoint. Now, we got to get to a bag, right? If we make $100,000 in the stock market, we might need $1 million. That's 10%. That's kind of tough. So we got to crawl before we walk. It's not like you close your eyes and start having capital gains, paying all your bills. No, you need to build up a nest egg, and that's why we invest. But I digress. Let's see what else they got to say.
This explains the 4 different types of income and how they can be taxed. First, we have the employee. This person works at a job and has a salary. Employees typically do not get to choose their income and have very little control over their taxes. Their taxes depend on their income, ranging from 10% for low-income workers under $9,700 and goes up to 37% for high earners with an income over $510,000. Now, on top of that, there are state taxes, which depending on the states, you will have to pay an additional tax. There are some states in the US that don't have any state taxes like Nevada or Washington, but there are others that go up to 13%, like in the state of California.
Profiteers, 13% taxes. Woo, 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 woo. In the words of Offset, that's bad, man. Now here in Florida, we pay 0%. So again, using $100,000, if I'm working, punching the time clock, I got to pay Ron DeSantis in the state of Florida, nothing from a state tax standpoint. If I'm in California, I got to pay Gavin Newsom in the state of Florida, 13%. Ugh, man. Now it's deductions, credits there as well. But man, you save yourself a nice amount of money. No wonder people are moving to Florida. Of course, it's sunny. The beaches is here. But no state taxes. Texas, no state taxes. North Carolina, no state taxes. So even if you don't like Florida, you want to go somewhere else, it's other places. But from a financial standpoint, no state taxes is good for the bottom line of your pocketbook.
A common misconception many people have is that if they earn even $1 more of their tax bracket, their whole income will be taxed at that new bracket. But that is not true. Only the amount that went over the tax bracket will be subject to that tax percentage, not your total income. There's still a few things employees can do to decrease their yearly tax bill. A common way workers in this category lower their tax bill is by investing their pre-tax earnings into a retirement account, like a 401k or an IRA. This lowers their taxable income, potentially putting them in a lower tax bracket. Now, this method does not eliminate taxes. It only defers the taxes for a later date when the money is accessed when they retire.
Now, this is correct. Very, very correct. And I like this. This is definitely some good content. Great content. Couple things though, right? It is a tax deduction. So if I make $100,000 and I put $10,000 in my 401k, from a tax standpoint, I'm not taxed on $100,000. I'm taxed on $90,000. It doesn't mean I saved $10,000 in taxes. It means I'm not taxed on $10,000. So again, using that 28% tax bracket per se, right? So instead of me owing, theoretically speaking, $28,000 before deductions, now I'm owing less because I'm taxed on $90,000 instead of $100,000. Number two, misconception. Your employer matches. So when you put money to the 401k, they might put money in as well. Using $10,000, you put in 10, they might match $10,000. But that $10,000 match that they do, you don't get to write that off. So if you put in 10, they put in 10, that's $20,000 put in your 401k. But from a tax standpoint, you only write off $10,000, not $20,000. So remember, your 401k is a deduction. You're not getting $10,000 of free money. You're just decreasing how much you have to pay. On the flip side, though, when you take the money out, you got to pay taxes then. So if I put in $10,000, yes, I deduct it. And now, 30 years later, that $10,000 is worth $50,000. It grew, right? On $50,000, I'm taxed on that $50,000 when I take out that money. If I'm in a 28% tax bracket, ooh, that's almost $15,000 of taxes. So I went from getting about $2,500 of write-offs to now paying $15,000 in taxes. That didn't kind of make sense, did it? That's why most people, recommendation standpoint, we talk about doing a Roth 401k because yes, you pay taxes up front. So in that case, I do not get to deduct that $10,000. I'm going to pay an additional $28,000. On the back end, in the words of Finesse Two Times, on the back end, when I take out that $50,000, I am not paying 15% taxes. Pay $2,800 up front, 15 down the road. No. I'll pay 28, not pay 15. And with taxes and inflation, who's to say taxes won't be up 10, 20, 15, 30 years from now? You know how it goes with taxes and inflation and the government. Whole nother conversation though. Government's not bad, but it is what it is. You got to pay for my military pension, don't you? Yes, you do. And I appreciate it, y'all. I appreciate it. Yeah, I appreciate it. And shouts out to all y'all veterans as well. But with that being said, though, Roth 401k might be the bigger bang for your buck. But when you put money into your 401k, it's a deduction, not a dollar for dollar credit.
Now, assuming that at retirement age, the workers won't have as big of an income, they might also fall into a lower tax bracket, making the total taxes paid to also be lower.
Maybe.
The second way people make money is through self-employment. This person has more control over their taxes since they are able to write off business expenses, which can lower their taxable income. But people who are self-employed also have to pay what is called the self-employed taxes, which is another 15.3% on top of the regular federal and state taxes. Normally, when you work on a job, your employer is responsible for paying half of those taxes, and you're responsible for paying the other half. But since you are self-employed and you act as both the employer and the employee, you are responsible for both sides of this tax expense.
That is very true. We're self-employed, I have my own practice. I'm actually an S Corp. I was an LLC. I changed to S Corp years ago, but that is true. But there's some ways that we can circumvent that. And again, from an investment standpoint, we are able to do what you call a SEP, S-E-P IRA. Unlike a 401k where you can put a max of, $19,000, $25,000, depending on how old you are. In a SEP IRA, you can do up to 25% of your salary up to $52,000, right? So if I made $100,000, I could do $25,000, not $19,000 in the 401k. If I made $200,000, I can do almost $52,000. But then also I can do a 401k. I can do a solo 401k. You can't do both. If you do a SEP IRA, it's a SEP, or you can do a solo or owner 401k. Owner 401k, you can max out your 401k and then do a profit share on top of that. And you get to stack a lot of money. Now, stacking that money up to $75,000 to $100,000, depending on how profitable you are. Great. However, though, again, it goes back to it's a deduction, not a credit. I made $200,000 between my profit share, my solo 401k. I put in, let's say, $100,000. That $100,000 decreases my taxable income. So the $200,000 taxes I got to pay, now it's $100,000. So it helps. But when I take that money out down the road, I got to pay all those taxes. So yes, you being self-employed helps, but it's not like you just saving all this money, right? I want to be my own business person. I ain't going to pay taxes. I'm over an LLC. An LLC is just a business filing. It doesn't really mean anything, though. If you don't got no money, you can't write nothing off. It's not like you can just say, I'm writing everything off. I ain't make no money. I'm going to get all this money back in taxes. No, sir, not at all. So self-employment helps. You being self-employed from a tax standpoint, if you're making revenue, is better, but it's not the end all be all.
So let's take a look at how much you would pay in taxes on a $250,000 income without any deductions. With a self-employed income of $250,000, this would put you in the 35% income tax for federal taxes. This means that you would pay $54,367 in federal taxes. But we're not done yet. Let's say that you live in the state of Oregon, where there's state taxes. Due to your income, you fall into the highest tax bracket of 9.9%, which means you will pay $21,195 in state taxes. But you are self-employed, which means that you will also pay self-employment taxes, adding another $23,174 to your tax bill.
That's right.
At the end, you end up with a tax bill of $98,738. This means that out of the $250,000 you made, you get to keep $151,221.
That hurts. That hurts. But again, that's why we recommend from an investment standpoint, doing a SEP IRA or doing a solo 401k, owner 401k, profit share that's going to help you from a self-employment standpoint. Ooh, that hurts. $98,000. Ooh, good Lord, that's a lot of money.
Travel, food, transportation, and even your clothes. If it all can be related to your business, it can be written off as a business expense.
This is true. We got to watch out though, right? If we have suits, as a financial planner, I wear suits, can't write all that off, right? So a lot of times we think we can write off things that we cannot. So very important, get with your CFP. More importantly, get with your CPA what you can write off or can't write off, right? We flying everywhere, going out all the time, spending money. Doesn't mean we get to write off everything, right? The thought process is, well, I'm going to promote my business. Yeah, but it has to be towards the business that affects the business. If it does not affect the business, then Uncle Sam going to say no. Now, when you get out of it, that's up to you. But just make sure you know everything that you do that you think is a business expense, really not a business expense.
The third way people make money is through a business, what Kiyosaki calls a big business. People in this category make use of legal entities such as corporations to host and run their businesses. The tax structures for corporations are a little bit different than the other two categories. In this category, companies can enjoy a variety of different tax benefits. For example, Elon Musk is leading in solar energy research with his company Tesla. The company is able to get a research and development tax break. If your company creates housing for low-income individuals, you might qualify for the low-income housing tax break.
Not so fast, my friend. So again, I went from self-employed to being a corporation. So I kind of know I'm in this game. I ain't making no money like Elon Musk, though. I mean, I'm saying I'm just a person trying to help people. But all the way down to 0%, I don't know about that. What I do know is that yes, having your own business helps, but having these huge tax credits, not so much. If I had an electric car company like Elon Musk and I got government funding, then yeah, I have some tax credits, right? But it's just not like you open up a business and you get all these tax credits. It does not work like that. Like the thought process is, I'm just going to have a business and I'm going to write everything off. It doesn't work like that.
Companies can also make use of debt to lower their tax bill. Many companies borrow money to pay expenses, assets, or build real estate or other investments, all while using their debt to offset their profit.
This is true. You can do this. You can take out debt because debt is not taxed as income, right? If I make $100,000, I'm taxed from an income standpoint of 28%, or from a business standpoint, maybe more, maybe less, depending on deductions. If I was to refinance something and use that $100,000 I refinanced from a house standpoint to buy another house, then yes, I'm not taxed on that. And I can write off the interest. However, I have to pay that back, right? If I get a 5% loan, $100,000, now I owe $105,000. So I got to pay back $100,000 plus I got to pay $5,000 of interest, right? If it's over 10 years and I don't see a profit from that investment, I lose money and I still got to pay you back plus 5% every year. That's $100,000 plus $100,000 as well from a compounding interest standpoint. So we can use debt to pay for things, but be very, 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 very careful, because you use that debt and you don't make no money. We got to pay that money back plus interest, and that is not fun at all. So be careful. Be very, very, very careful.
If you are making money with your business and you buy an asset with debt, which is tax-free, you're able to use your profits to pay your debts, lowering your taxable income while increasing your equity on your assets.
Just be careful. If we have a gain, then we might have to pay taxes. Talk to your CPA or your CFP before that, right? Got $100,000 with that debt I paid for. Now I sell that house for $250,000. Then yes, it pays off that $100,000 debt. But the $50,000 I made, I got to pay taxes on that, right? Like a house. If I buy my house for $100,000, I got a loan, I owe $50,000, I sell that house for $200,000. Before I get a dime, that $50,000 goes to the mortgage company, right? So that's right. But the other $150,000 I got to pay taxes on. If it's your primary home, you don't. But if it's a secondary home, then you do. So it's not like we make profits. It's not like we invest in something, make a profit, and those profits are tax-free. Not really. It goes towards the debt, and whatever's left, we still got to pay taxes on that. So,
You're able to turn profits, which would be heavily taxed, into asset equity virtually tax-free using debt. If you own a corporation, you can pay yourself a salary, which is taxed like regular income like any other employee, which can go up to 37%, not including state taxes. But what if you pay yourself a small salary and instead you pay yourself the majority of your income in dividends or distributions?
yes, you can do that. And I had a conversation with my CPA years ago. We went from sole proprietorship to S Corp, right? Because I had some clients that did that. Thinks to be a good idea. What about Social Security? Now, some people think Social Security is going to go away. Politicians' number one job is get reelected, so they are going to find a way to continue Social Security. Going to raise taxes, raise the limit of income. We don't know, but Social Security ain't going away in 2034. It's going to continue. If I only pay myself $50,000 and everything else is a dividend and distribution, that's good for taxes, right? But then I'm only making $50,000 total Social Security compared to if it's $150,000 or $200,000. Well, it's a cap, right? So it's a cap of $189. But if it's $200,000, then it's more money going to Social Security. So when I retire completely, then I'm gonna get more on Social Security. Now, people have negative and positive thoughts about Social Security. I'm not getting into that conversation. I'm just saying you pay yourself in the form of dividends and dividends and distributions. Yes, you are lowering your taxable income, but your Social Security is going to be less. I had a client, I'm thinking about in my head, that for years he paid himself a very, 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 very small amount of money. But then when it came to Social Security, he got a very, very, very small amount. So just think about that. That is true, but there's pros and cons to every decision.
Which are taxed at a much lower rate.
True.
Now, there are laws in place to avoid corporations abusing this strategy, stating that you must give yourself a reasonable salary.
Did I just say that? Okay.
And not break any laws. Now, dividends and distribution taxes top off at 20%. This means that the portion you pay yourself in dividends will only be 15% if you make under $434,000 or 20% if your income is over the $434,000 mark.
Average American household, $68,000. Average small business, not even close to that, right? So these are top 1% of income, right? So don't think of it as y'all rocking and rolling. People with small businesses rocking and rolling. It's tough to build a business. It's tough to sustain a business. These are large numbers. But the more the story is, if you want to do it this rate as a small business owner, your Social Security is going to be way less, way, way, way less. And you might not be able to reap the benefits depending on how much income you make.
Income is not subject to self-employment tax, so you'll be saving around 15% in self-employment taxes alone.
That is true. No self-employment tax with a less self-employment tax is good. That is true. So pros and cons to every decision.
Some of the biggest tax breaks happen in the right side of the quadrant, in the business side, as well as in the fourth category, which is the investor side. Now, just about
Did I just say that?
anyone can take advantage of some of the tax breaks that the investing category offers. For example, if you are an employee or self-employed, but you saved and invested in real estate and you sold your property at a profit after holding it for 1 year, you can take advantage of the capital gains tax, which states that as an individual who held an asset for over a year can pay down to 0% in taxes if your total income is below $38,600.
If we are accumulating real estate, who's making less than $38,000? 15% gain. Primary house, over $250,000. Yes. Under that, no taxes at all. Real estate investments, though, capital gains.
And maxes out at 20% if you make over $425,000. But if
There we go.
you reinvest the profits back into real estate, no matter your income, you will pay no taxes at all. This means that you can turn your profits into equity without having to pay any taxes.
That's true. Quasi 1031 exchange, like life insurance policies, 1035 exchange, this exchange, but it's a certain time limit. Not like we can sell our property and then wait 2 years for the best deal. But if we use those proceeds to go into another real estate property once the house is sold or property is sold, yes, but it's a time limit though.
Now, many entrepreneurs use their business's income to fuel their long-term investments. This way, they're able to take advantage of both corporate tax breaks as well as investor tax breaks. For example, if we think of how McDonald's makes its money, we think of burgers and fries. But in reality, McDonald's makes its money with real estate.
They sell a lot of burgers and fries too.
Franchise, meaning other people can own and manage the McDonald's restaurants as long as they follow the structure set by the McDonald's Corporation. McDonald's used their early business cash flow to buy real estate where the restaurant resides. Each McDonald's franchise owner is like a tenant paying McDonald's rent, not only to use their brand and business model, but also to rent their building. This makes McDonald's the landlord and the franchisees the tenants paying rent.
But you got to be selling burgers though, because if you're in an area where you ain't selling no burgers, ain't selling no fries, you got the business acumen to do what you want to do to be successful, then you're gone. And that real estate is sold by McDonald's or done something else. Now, it's tax write-offs involved with that, But these are big corporations. The everyday people that's just making a living, doing what they're doing to survive, providing for their family, they don't have these huge tax breaks. And that's what I wanted to talk about. I don't want you to get the idea that you have your own business, be self-employed, you're going to get all these tax breaks. The rich get rich because they have the manipulation processes in place. But the regular, everyday people feeding our family, we don't have those processes. That's why it's good to stay out of debt, decrease our liabilities, invest, take advantage of some of those tax breaks that are out there. And over time, we can then use the tax code to our advantage. Hopefully, I was able to give you information about the information as my first reaction video. So y'all let me know, comment below. More reaction videos, waste of time. You like this, my convos with the CFP, where I'm actually saying, talking to clients as I have 1,100 clients and kind of those conversations, hypothetical, of course. Let me know, here to help as we continue to build, continue to educate. As always, y'all be healthy. Let's make some payment profits together, y'all. Peace.